This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you're not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Jim's picture that says, looking for the downloads. Eric, let's cover crude oil, starting with the EIA inventory.
EIA printed a massive build of 7.9 million barrels. Now, that was really only 6 million barrels after you consider that 1.9 million of those barrels was pilfered from the Strategic Petroleum Reserve. That was the 11th weekly draw in a row. And, of course, they're promising, don't worry, they're going to refill it any day now. Haven't we heard that before? Since September of 2021, the Biden administration has drained 269 million barrels. That's 43.5% of the oil that was in the SPR as of September 2021, which has been drained out now by the Biden administration. Still making promises they're going to start refilling it any day now. Cushing, Oklahoma, building 1.6 million barrels, gasoline building 2.1 million barrels, and distillates building 2.1 million barrels. So it's builds across the board, which of course is bearish for prices. U.S. production stayed unchanged at 12.4 million barrels. That's holding a new plateau in terms of production levels reached since the COVID pandemic. In other words, we were above this level before the COVID pandemic, but so far 12.4 is the high print since the COVID pandemic. And we're just starting to see the beginnings of a breakout after, for I don't know how many months it was, that we were stuck at 12.3 million barrels. Looks like U.S. production is finally going to start to grow again. We'll keep a close eye on that in coming weeks. Tape action was down on the inventory released, then bounced briefly, and then on the FOMC statement was down even more. OPEC's gesture of holding their price cuts and Saudi Arabia's voluntary cut seem to have been forgotten completely as prices are right back down to where they were before the OPEC news. It seems like OPEC's bark is losing its bite, so to speak. I think that OPEC will be proven right in the end, but it may be a while here. It seems like the market is much more focused on demand than supply, and the OPEC story is a story about supply.
Yeah, on page 2, we have that chart of crude oil. I have the 100-day moving average on there. And what we continue just to see is that oil remains stuck in this distribution cycle, trading right along those 52-week lows, and is still vulnerable for a potential washout event down to retesting 65, 64, or even a temporary drop down to $60. Overall, I think this level is going to prove to be where the bottoms are going to be and where the buying opportunities will emerge. But on the short term, it may be a little bit more pain before we establish a trend reversal. And so right now we have to respect that the bears continue to be in control of this price action. Nonetheless, Eric, let's move on to the equity markets and S&P 500. What are you watching here?
Well, we blasted through the 61.8% fib retracement, and so according to the lore of technical analysis, that means the market is either about to reverse here, the bear market rally is over, or we're headed toward new all-time highs. Usually if a market goes past a 61.8% retracement, it's going to go all the way back to a 100% retracement. Of course, that's never guaranteed. Technical analysis is a study of potential outcomes and probabilities, not certainties. As I mentioned last week, I shorted the S&P from 43.09. I also added to that short position when it hit 43.60. So I've got my full short position on. We'll see what happens. I haven't been stopped out so far, but by next week, we'll see what happens.
All right. Listen, let's get to Nick here. And Nick, on that S&P 500, what levels are you watching?
Current spot price is 43.60 on SPX. There's a call wall above at 4,400 and a put wall below at 4,000, which is also heavy support. The implied move for the July 21st monthly OPEX is 120 points. So the upper expected move is 44.80, just below the key level of 4,500. And the lower expected move is 42.40. Key resistance right now, again, as I mentioned, is above at 4,400, and key support below is at 4,300, 4,250, 4,200, and then that key level of 4,000. Now, as we've run pretty high the last few weeks, as expected, we broke below that 4,300 with gusto, pushed near that 4,400 level yesterday, where the call wall is, and then came back off of that on the FOMC decision. Now, I'm inclined to think that we're going to see some sideways action perhaps over the next couple of days into Friday's OPEX. And next week, we could see a decline perhaps back down to test that 4,300 level. Keep in mind that next week is also a short week as Monday is a holiday. So there's a 4-day week next week. I do think we test out that 4,300 level, possibly 4,250 before resuming upside, if at all.
Well, it's interesting you mentioned the 4250 level because that continues to be actually an interesting focal point for me as well. Obviously, one thing that we didn't mention is obviously at the end of the month comes the JP Morgan whale with the huge collar in there, which has a big gamma pin for June 30th sitting around 4320. What will be really interesting to see is do we kind of trade lower and then higher and then kind of pin into the end of the month into this pocket is certainly something I'm going to watch closely. On the short term, the way I look at this is that the market has a real chance of having had a buy the rumor, sell the news on the Fed pausing. And I think that we may be seeing swing highs. I'm not so sure I want to already call it a major high or something like this. And it's such a strong bull trend that I think it's a little dangerous trying to be so bold. But I think that the market has, at least on the short term, reached an exhaustion point, and a lot of backfilling and consolidation and chop within that 4,250 to 4,400 range is quite likely. Nonetheless, let's talk about those NASDAQ levels.
So NASDAQ right now for triple Qs, the spot price is 363. The call wall is above at 370 and the put wall is below at 350. The implied move for the July 21st monthly OPEX is plus minus 18 points. So the upper expected move is 381 and the lower expected move is 345. We have key resistance right now at 372 just above, which was the high from March of 2022, and key support below at 335. Now, given how hot we've seen a lot of these tech names run, I do expect a pullback pretty shortly, and I think that we can test out that 335 level, I would say, by the July OPEX. But it wouldn't surprise me as well to see a push toward the upside of around 380 or so. That could be the kind of blow off top prior to a test of those lows. So right now, the best way that I'm positioning myself is to sell bear call spreads on the Qs and SPX out of the money, because if you get sideways action, you win. If you get a little bit of upside, you win. And if you get a pullback, you win. Whereas if you're buying puts, for example, you have that time decay element and you need to be correct on the timing and also the magnitude of the move as well. So I'm very, very cautious here. I'm still riding some of my long positions, which are longer term, but I am selling bear call spreads out of the money to hedge the downside overall.
Well, you know what's interesting, though, when we look at page 6 where we have that VIX, selling premium is interesting, but we definitely have very low levels of vol, at least from a multi-year range at the bottom end, where you have to go back to like 2021 to see these kind of levels of volatility. And one of the things that's going to be interesting is will this be a new lower consolidation? Will we see the month of June continue to just stay, below 16 and just chop back and forth in this lower boundary? What's your take on the VIX?
So with the VIX right now at 14 or so, we're looking at expected moves daily of less than 1%. And a lot of market participants are looking at hedging by buying puts. I think the correct way to do this is to perhaps look at selling bear call spreads, which is more of a neutral strategy / bearish. So as an example, if you want to trade downside on SPX, you could sell the 4,400, 4,410 July 21st OPEX 10 wide bear call spread. That gives you a credit right now of about $5. Keep in mind, it's out of the money, and you're still pulling in $5 credit on $5 risk. So that's an example of a way you could trade using this lower level of VIX, because again, you want to sell puts right here when the VIX is so low? Probably not. If we get a spike in the VIX, that correlates with a downside movement in markets, and you get burned pretty fast. So I think right now you need to be very cautious. Looking at the 5-year time frame on the 5-year chart on the weekly time frame on the VIX, we tend to see these pops from these low levels of 14, 15 up to highs of 25, and those coincide with sharp movements to the downside. So very important to be cautious right here.
All right. Well, I'm certainly going to check that trade out. Anyway, let's go on to the dollar. Eric, what are you thinking here on the dollar index?
Well, we had a nice rally up to 104, which was a key technical level. Now we're drifting back down to the middle or lower end of the wider consolidation range. But grand scheme of things, we're still in a consolidation until we have a daily close above 105 or below 100 on the dollar index. It says to me we're just in this consolidation, waiting for a signal as to what's going to happen next.
Yeah, Eric, I highlighted the trade range of the dollar. You can really observe this kind of 101 to 105 level has pretty much contained all the price action of the year. And I continue to think that this trade range will continue to prevail until ultimately the dollar is given a catalyst, most likely with an economic downturn, which could potentially see a bull breakout. But we may end up spending the summer just chopping in this trade range. It'll be interesting to see how this plays out.
And moving on to page 9, we have that chart of the gold futures. What are you guys thinking here?
Well, as you can see on the chart, gold has been consolidating above its 100-day moving average, and that has taken it right through channel support at 1969 on the August contract. That's the purple diagonal line that you see drawn on the chart there. We need to get back up above that line into that channel, and we need to get there soon, or else there's an increased risk of a pronounced drop into a deeper correction. And that is my base case. It feels to me like this whole rally in gold has been a little bit too easy. I wouldn't be surprised by a deeper correction, maybe as much as another $100 down from here to $18.50 or so, to shake out the weak hands before this very, very bullish market eventually resumes its upward trajectory.
Yeah, Eric, I continue to think the price action is a little bit disappointing here on gold. It's very distributed. Almost all rallies are failing. At this juncture, what's clear is we've put some sort of a short-term high in. The question now is this consolidation going to last into the summer? I suspect that the real big gold bull move is reserved for a little bit later in this year. And I'm in the camp that thinking that the continued consolidation and backfilling of this gold move is the most likely path of least resistance. Nonetheless, I wanted to wrap up by just touching on the uranium chart. Here I have the U308 contract. We continue to see the bull breakout that happened several months ago continue. It really appears at this stage that uranium is set to test those 2022 highs up near the mid-60s. It'll be really interesting to see whether uranium can maintain this trend. It's one of the very few commodities that seem to be working very well right now.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Seresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.